Financial markets currently project a sense of stability. The prevailing consensus among investors suggests that the current conflict in the Middle East will be resolved quickly, either through a decisive U.S. military intervention or a swift diplomatic settlement. That optimism ignores the physical reality on the water. For nearly a month, the Strait of Hormuz has been effectively closed to standard commercial transit. The blockade relies on the MAC warfare. The interceptor missiles used by the U.S. Navy cost millions and take days to manufacture, while the drones and missiles they are meant to stop are cheap, plentiful, and easily replaced. This munitions mismatch forced a tactical retreat. Because they cannot guarantee air defense against sustained swarms, U.S. aircraft carriers have pulled back over 750 kilometers into the Indian Ocean, leaving the immediate combat zone. Geography dictates the terms of the fight. The Strait of Hormuz is only 22 miles wide. In a channel that narrow, a multi-billion-dollar carrier loses its ability to maneuver, becoming a target for land-based batteries. Physical supply chains are now on a countdown. While the market waits for a diplomatic solution, global inventories are within 2 to 3 weeks of total exhaustion. This chart shows the collapse of global energy price discovery. While Western benchmarks have stayed relatively flat, physical Oman crude has climbed toward $170 a barrel. The market is splitting between paper prices and physical reality. This divergence is triggering a crisis for energy-dependent allies like Japan and much of Europe. Without access to Gulf crude, these nations are facing immediate physical shortages and the prospect of fuel rationing. To keep their economies running, these nations must secure whatever fuel remains on the open market. Securing physical energy takes priority over holding debt. Foreign nations hold $9.5 trillion in U.S. treasuries, selling them aggressively to pay for energy shipments. The blockade has inadvertently placed American allies in a position where they must survive by liquidating the debt that underpins the U.S. bond market. This creates a direct threat to the fiscal stability of the United States. The closure of the strait forces a mass sell-off of Treasury bonds, undermining the debt market used to finance the federal government. Beyond crude oil, the Strait of Hormuz is the primary exit point for two less visible but equally vital commodities: liquefied natural gas and helium. These gases are the lifeblood of Taiwan's semiconductor industry. Without helium and LNG from the Gulf, the precision machinery required to manufacture microchips cannot operate. If the strait remains closed, Taiwanese chip manufacturing halts entirely. A chip shortage strikes the Nasdaq directly. Tech giants reliant on AI hardware suddenly find themselves without physical components, causing market valuations to plummet. The conflict over a regional waterway physically starves the global tech industry of raw materials, stripping away the belief that digital economies avoid physical logistics. A crash in the tech sector moves quickly into the broader economy. In the United States, consumer spending accounts for 2/3 of the total gross domestic product. 200% of recent U.S. consumer spending growth is driven by stock market gains and IRA distributions. If the tech market remains paralyzed, this engine disappears. Total spending cannot expand if the underlying assets lose value. Because the U.S. economy relies on these market valuations to drive consumption, a sustained drop in equities creates a structural contraction. Without market growth, the economy enters a recessionary cycle it is not positioned to absorb. In 1956, the aerial view of a blocked Suez Canal signaled that the British Empire's control over global maritime trade was ending. Today, the paralyzed traffic in Hormuz represents a similar shift in power. For 4 centuries, global power has been defined by naval supremacy, the ability to control maritime choke points and dictate the flow of trade. A regional power using land-based drones and missiles has successfully stood off the most expensive navy in history. This stalemate has altered the calculus for every nation relying on American security. They have watched billion-dollar carrier groups sidelined by inexpensive precision weapons. This standoff accelerates the global shift toward de-dollarization and multi-currency reserves. For the first time in 400 years, the assumption of absolute sea power dominance has met the physical reality of the drone.